Welcome to the Lifestyles Unlimited Real Estate Investor Radio Show, a real estate investment program. Listen and learn how to use real estate to build wealth and passive income streams for you and your family. We bring you experts every day to discuss and answer your questions on everything from single-family homes all the way up to 600-plus unit apartment complexes. And now, the Lifestyles Unlimited Real Estate Investor Radio Show.
Welcome to the show. My name is Al Gordon, and as always, I'm working on your financial freedom. And to be honest with you, I'm not doing it by myself. I am not out here by myself doing radio and giving you information. No, that's not how I exist. I don't do this real estate investing by myself. I can't do it by myself. If I did it by myself, I would be doing it all by myself. And that would be very lonely. It would be absolutely lonely for me. I'd be all by myself. It'd be like being deployed again. That's not a lot of fun. And if you don't know what it's like being deployed in the military, I'll give you something that I think is very similar to it without the shooting. COVID. Yeah, COVID. The lockdowns and everything, it's kind of similar to being deployed. So if you never served in the military and you always wondered what it was like for those service members overseas that are deployed, you got a taste of it. Yeah, you have to, not go anywhere. You can't do what you want to do. You're at somebody else's beck and call, so to speak. All right. That's not what I want to talk about. What I want to talk about is some of the great information that the members of Lifestyles Unlimited have been sending me. Yeah, I tell you what, one of the neatest things about Lifestyles Unlimited is the fact that we as members, we communicate with each other. And you start off getting to know people. You start off getting to know what their background is. You get to know what their experiences are. And then you get to know them as people. And you find out that many of the members of Lifestyles Unlimited probably have a similar background or experience to you. Now, the one common thing we have in common, the fact that we all realized that what we were doing for retirement probably wasn't working. I mean, it was clear as day to me when I retired from the military and found out that I was not financially retired. Physically, yes. Financially, no. No, I had a lot of work that still needed to be done. And my challenge was I was already at the age of 50. So I had already burned 50 years of my life, and I had to make some corrective action. Now, my game plan involved me going back to work, and that didn't sit so well with me because it got in my head that I was retired. But I wasn't really retired because I couldn't afford to support the lifestyle that my family had without going back to work. There's a guy by the name of Ken. Now, Ken is a fellow Lifestyles Unlimited member. And this guy, he's got a very interesting background. And I'm going to tell you a little bit about Ken because Ken's one of those guys that studies markets. He does deep dives into things because he wants to understand the marketplaces. And when he gets it all dialed in and gets it all figured out, he doesn't hoard the information. What he does is he shares the information. He shares the information with his fellow Lifestyles Unlimited members because you don't need 50,000 people doing the exact same market research on all the markets that we invest in. No, you really don't need that. As a matter of fact, all you need are a couple of Lifestyles Unlimited members that know what they're doing, kind of doing that deep dive, and then presenting that information to us to kind of, chew on, to machinate a little bit. And if we see something that, seems a little off, we'll call it into question. But for the most part, none of it's really off because it's all very well qualified information. And that's kind of what Ken does. Now, let me tell you a little bit about Ken. I mentioned Ken on yesterday's show. I don't know if you had a chance to listen, but Ken's one of these guys that lives in Southern California. He does not invest in Southern California. Now, I do have to caveat that because he does own 2 commercial properties in California. And he owned those properties before he became a member of Lifestyles Unlimited. Yeah, so those properties are doing whatever they're doing for his investing strategy. But when Ken came to Lifestyles Unlimited, he realized that he wanted to up his game and to start getting better returns on his investment and really to kind of get away from the California mentality of investing, which is throw as much money as you can at an asset. Maybe you can get it to cash flow. Whatever you do, just own that asset. Just own that asset. Even if you have to dig into your pocket every month to keep that thing afloat, just own that asset because appreciation is going to take care of you. That's kind of the thought process in California. And I'm here to tell you that kind of works in California, but it doesn't really work everywhere else. And the other problem with that California investing model is that you have to take so much cash and put it to work in an asset just to get it to break even or even have positive cash flow. At the end of the day, what you're creating for yourself is something called debt equity. And that debt equity is just money that sits in the asset that really isn't doing anything for you. Now, Ken fully understands this concept of debt equity, and he knows how much of a profit killer it can be. He does, because we taught him everything that he knows about investing in commercial real estate, but let me caveat my statement, from the residential income producing side. That's what we do at Lifestyles Unlimited. We own and operate housing units, either in the single family space or in the multifamily space. It doesn't matter. If the units are designed to provide clean, functional workforce housing for a demographic of the population that desperately desires it, that's where we're going to be. Now, I will also add to my statement a little bit because I want you to understand one thing. Just because it has residential in the name doesn't mean we invest in it. I know we actually tighten that shot group up even more. So things like condominiums, we don't invest in those. Things like townhomes, nope, we prefer not to invest in those. Things like mobile homes, we don't invest in those. Mobile home parks, nope, not those either. And the reason we don't invest in those is not that they're not profitable per se, but they're just not the most effective way for you to invest your money. Now, when we come back from the break, I'm going to share with you a market analysis that Ken sent me. It's really going to open your eyes. Stick around. Welcome back to the show. All right, with no further ado, we're going to get into this analysis. Now, you're probably thinking that because Ken is a Californian, maybe this analysis is going to be on one of the major markets in California. And the answer is no, it's not going to be on a major market in California. Now, you might be thinking, okay, maybe he's going to a secondary or a tertiary market in California, because there has been a lot of information put out by different news sources that are talking about how, because there's so much demand going into and after multifamily assets, investors are looking to migrate even into the tertiary markets, which are the markets beyond the secondary markets, because it's those markets that are showing the greatest potential for returns. But that's not what Ken's doing. No, what Ken did was he went to probably the number one market in America. I think it might be the number one market. And actually, when I get through telling you what Ken thinks, you might agree too. Phoenix. Yeah, Phoenix. So Ken lives in Southern California, but he's investing in Arizona because he figured out that his money would do so much better for him in Arizona. There's a lot of reasons why, and we'll kind of get into those things. But let me just give you some background on Ken, so you know who is providing this statistical information that I reviewed, and I think he's got it right. So if we're both wrong, send me an email at askal@luinc.com. That's askal@luinc.com. Let me know what we got wrong, and if we got it wrong, we'll admit it. But I don't think we got it wrong. So Ken's a guy that managed to become a corporate executive. Yeah, he was a big shot in corporate America. As a matter of fact, he was one of those tech guys. Yeah, he was pulling down the big salary. And those of you in the tech field in California, if I told you that he's a corporate executive and he worked in the tech industry, you probably already have in mind what that dollar range is. Okay. The reason I want you to put that dollar range in your brain is I want you to understand that Ken was able to step away from that. He was able to walk away from all of that because he replaced his income source with real estate. So instead of trading time for money, instead of, working those crazy hours that he was working, trust me, the guy was good at what he did, but I think he's even better as a real estate investor. He was able to replace that six-figure income. It's gone. And he's replaced it with the income that comes from correctly investing in real estate. And one of the things that Ken realized immediately is that if he kept investing in California, he would probably do well when it came to appreciation. But appreciation is just one of the ways you make money in real estate. And most appreciation is market driven. In other words, you and I can't do anything to affect that number. Okay, we can do a little bit, a tiny little bit, but we don't control market forces. So Ken realized that, and he started looking at the amount of money he had available to buy assets with. And if he looked at the money and said, okay, if I take this money and I buy an asset over here, I have to put a bunch of this money into play. Now, it will produce some cash flow. I'll get some cash flow coming off of it. But man, that return on the cash flow, that's kind of low. The percentage of return is very low because you have to put so much money in just to get the cash flow out. But then he compared it to a place like Phoenix. And what he learned was that he could buy assets in Phoenix. He could put all his money to work. He was able to leverage the property correctly. In other words, he didn't have to overcompensate for the property to get it to cash flow by putting 30, 40, 50, 60% down. No, he could get into the sweet spot, which is we'll call it the 20 to 30% down zone, because what that allows you to do is to bring in a participating entity. It's called a lender, okay? And when that lender comes in, they come in at the amount of money that they said that they would loan you. So everything that happens with regards to appreciation, it all falls in your lap. Yeah, they don't participate in any of that equity growth. It's actually a very, very good thing. Now, here's the other thing that Ken realized. He realized that by buying these Arizona assets instead of these California assets, that he didn't have to have as much money in the deal to get the cash flow coming out, which means he was able to distribute his cash over even more assets. Okay, so if you're somebody that believes a little bit in diversification, I think that's a good way to diversify. Just don't throw all your money into one asset, throw it into multiple assets, and then just move the assets around. That's kind of what I do. That's exactly what I do. And that's what Ken did. So what Ken ultimately did was he went to work replacing all of his income. And he did it. And he went to Arizona to get it done. Now, he still has those properties in California. He still has them. They've got a certain metric on them. But one of the things Ken would admit to you, if I had him on the radio show today, as a matter of fact, I might have to get Ken onto this radio show because I want you to hear firsthand from Ken how he did it. But more importantly, those assets in California, he has a target for those. In other words, he's got an exit strategy for those assets. But he would be the first to tell you that if he could trade them in right now for Arizona assets, boy, he'd get that done. Now, here's something else I want to share with you about Ken. I'm going to share with you his business motto. Yeah, this is not something that, he plucked off the Lifestyles Unlimited website. And if he did, that'd be okay. We're totally fine. Our members can use anything that we have. We're totally cool with that. But this is what Ken does. And he sums it all up in his company motto. He says, we look to acquire undermanaged properties running in the red or black where we see the opportunity to squeeze out the green. Yeah, his entire investing philosophy is summed up in his motto. I mean, he's literally thought this through. Because one of the things that Ken knows now that he didn't know prior to becoming a Lifestyles Unlimited member was how to effectively operate properties. You heard me correctly, to effectively operate properties. And when you know how to effectively operate properties, one of the things that kind of comes right to the forefront is the fact that you're able to go in and determine where things are not going well. And not everybody that owns real estate, especially multifamily real estate, knows how to effectively operate. Now, there are operators out there that believe what you do is you just turn it over to a third-party management company. And they just figure that if you're doing that, well, you've got professional management in place, right? Well, Ken would disagree with you, because Ken would tell you, even though you have third-party management managing your properties, you still have a responsibility to manage the manager. Yeah, so you're really not 100% hands off, but it's totally fine to have people doing the bulk of the work for you. All right, you want to know what Ken thinks about Phoenix, and you know what? I'm going to tell you. When we come back from the break, we're going to get into this market study you did. Stick around. Welcome back to the show. All right. So Ken is citing a couple of major sources. Now, I want you to understand Ken didn't just make up this information. Ken is really good at doing demographic research. I mean, if you knew what he did in the real world before he became a real estate investor and then wrecked that career he was excellent at understanding his customer. Okay, so one of the things that Ken focuses on when he goes into an area is he wants to know what the economic drivers are in that particular area. It's the information that he uses that makes him say, I want to invest there. And what Ken did was he presented a bunch of information to all of us as Lifestyles Unlimited members that have a relationship with him. And here's the amount of information he gave us. You ready? Buckle up, because it's going to be a lot. The first thing that he did is he took a look at what Freddie Mac reported. Now, Freddie Mac, they are one of a couple of entities that buys all the mortgages in the United States. It's like a clearinghouse for mortgages. But just know that they got their hands in a lot of things. Okay? And they can call some shots in the multifamily markets that you must abide by, or you're not qualified to use them as a lender. Yeah, it's kind of interesting. Okay, so Freddie Mac says this. A lot of growth areas. Freddie Mac reported that multifamily has really excelled when it comes to the different areas in the country. And one of the things that's going on is the fact that we have a lot of areas of this country that are growing very, very fast. I mean, you've seen it on the news. You know that people are moving about the country. Some places are growing, some places are not. Well, one of the things that you want to understand is the growth rate for an area. And here's why. Growth rates create demand for your product. In other words, if you have 100 units in a town, but you have 110 families that want to live in those 100 units, you have a level of population that is greater than what you can supply. So the demand is greater than the supply. I know I'm taking you back to basic economics. Sorry. At the end of the day, if that demand goes up, let's say it's 115 families now, but there's still only 100 units, that's going to increase demand. And what demand tends to do, and we're seeing it right now, and it's fully driving a lot of the natural appreciation that's occurring in the markets, is that supply, when it is scarce, and demand, when it's not, when demand outstrips supply, prices go up. And we're seeing a lot of that. And it's not just in housing. It's in a lot of things right now. Okay. So, Phoenix. Phoenix was rated number one for growth in 2021, and it is projected to still lead the rest of the country. Now, not too far behind Phoenix were Las Vegas, Tampa, Tucson, and Albuquerque. Those are the top 5 multifamily performers that Freddie Mac thinks will lead the marketplace. And I think they're pretty spot on, unless something happens, a couple months from now that we didn't see coming. Kind of like, COVID came into play 2 years ago. We didn't see it coming, right? All right, here's the other thing. Freddie Mac expects the growth in 74 different markets that it measures to be led by the Phoenix market. And they're anticipating that the rent growth in those markets, in the Phoenix market, will get to about 8.2%. They believe Tampa will go up by 7.7, Vegas by 7.4, Tucson by 7.1. So what you've heard so far is Freddie Mac is just giving you statistical information and trend analysis. And here's what I know historically. Phoenix has been on fire for forever. I'm serious, man. I remember I went to school at the University of Southern California. That's where I got my baccalaureate degree back in 1986. And I had some fraternity members that lived in Phoenix. So every once in a while, I had a chance to go visit them at their homes. And Phoenix was growing even back then. Now Phoenix continues to grow. And Phoenix continues to attract businesses. It continues to attract people that want well-paying jobs. It's got a lot of good things going on for it. Now, here's another thing that Freddie Mac pointed out. And actually, I think this is. I'm going to give the plug to Ken because I don't think this is a Freddie Mac thing. I think this is Ken basically doing his market research. He said of the 5 top cities that he was looking at as far as growth potential, because he only wants to go into areas where people want demand for his product. Okay, makes sense, right? He said there were almost no multifamily properties available to buy in Vegas or Albuquerque that really met his criteria. So he kind of eliminated those towns. So really, Ken's been looking at Phoenix, he's been looking at Tampa, and he's been looking at Tucson. Now, here's what I know about Ken. He owns multifamily properties not only in Phoenix, but he owns multifamily properties also in the Tucson area. He doesn't own anything that I'm aware of in the Tampa Bay market. That doesn't mean he wouldn't go there and start something, but that's not what he's doing. The other thing that I think you need to understand about the markets is the fact that there are some markets that are on the bottom. There are markets that are on the bottom. Now, some people will think if you go to those markets that are on the bottom, they really only have one way to go, right? I mean, that's kind of the conventional thought. But I will tell you this. Things that go down can continue to go down. Yeah, they just because they're on the bottom doesn't mean they have bottomed. There are some strategies out there that say go to the worst markets and just find the worst assets. And as long as you position that asset correctly, you're going to take the market share away from what market share that's there because now you'll have the only nice thing on the market. All right. Well, I think that's a mediocre approach to investing. I think that makes no sense at all. I think you go into markets that are growing because if there's demand for the product and you can go into that market and you can fill that demand with clean, functional workforce housing that people literally will compete for in order to get the lease on, I think that's the way to go. And the other thing is, when you're looking at rent projections, I mean, an 8% or more rent increase is pretty significant. I will tell you this. Here's a little insider information that I'll share with you. You'll learn this at Lifestyles Unlimited, but I'll share this little piece of information right now. When you own an apartment community, you have the ability to do something called forcing appreciation. And it has to do with the fact that multifamily apartment communities are valued the way other commercial real estate is valued based off an income approach. And what we teach our members is that if you can increase your net operating income by just 10%, what that tends to do for you is it tends to double your cash flows, and it also tends to set you up for a doubling effect for the amount of money that you put into the property. Now, if the market's going to take care of over 8% of the 10 you're trying for, how hard is it to get the rest of it? And I will tell you this, when you follow our approach, it's not hard at all. So when we come back from the break, I'm going to give you the rest of Ken's analysis, and it's going to blow your mind. Stick around. Welcome back to the show. All right, let's jump into these stats because, man, I'll tell you, it's just going to open up your eyes. So there were three primary statistics that Ken looked at, and he wanted to know how all the major markets, I'm talking about the primary markets, the big cities, do when you compare them to each other. And what he analyzed was year-over-year rent growth. He wanted to see how these cities stacked up. And this is what he found. He found that there was, across the board, spectacular rent growth in 2021. Yeah, it really didn't matter what market you were in. I mean, the national average came out to about 13.5%. That's pretty significant. Now, some markets didn't do as well. Some markets like Washington, D.C., or Los Angeles, or Philadelphia, Indianapolis, Chicago, they were actually at the very bottom of the rent growth analysis, but they got pretty close to the 10% rent growth in 2021. It's part of everything that was going on last year. So you're probably wondering, okay, if those guys are at the bottom, who's at the top? Well, I'll give you the top 5 cities. Vegas came in at number 5, Orlando number 4, Miami number 3, Tampa number 2, and at number 1, Phoenix, Arizona. Phoenix, Arizona outpaced all other markets based on year-over-year rent growth. I mean, it came in above 25%. I mean, that's just crazy. It's crazy. Now, here's another thing that Ken wanted to look at. He wanted to look at the year-over-year rent growth, but he only wanted to analyze markets that Lifestyles Unlimited members tend to gravitate towards. Lifestyles Unlimited members do not invest in every state in the United States. And there's a lot of reasons for it, and we go over it in detail when you become a member. But at the end of the day, there are certain markets that are better positioned to give you the best returns on your investment. And lo and behold, 2 markets that came right to the top just based on some of the criteria we use at Lifestyles Unlimited. Phoenix was number 1 again. Now, Vegas came in at number 5 again, but still, should you put your money, here's the question for you. Should you put your money in Vegas or should you put it in Phoenix? Well, that is a difficult question to answer because here's the thing. Both of those markets are showing very, very good rent growth. But how do you decide? Okay, I'll just tell you how Al decides because, believe it or not, Al grew up in Las Vegas. That's where I was born and raised. And what I saw growing up in Nevada was a bunch of Californians moving into Southern Nevada and bringing a lot of their policies with them because they couldn't afford to live in California. So they came to Southern Nevada and they kind of wrecked the way Vegas was. I'm just telling you the way I saw it as a kid. And as a result of that, Nevada tends to have policies for housing that are closer to what California has. Now, Arizona, they're a little different. Arizona tends to be closer to like Texas when it comes to laws with regards to housing. I like the fact that Phoenix is pro-landlord, and I like the fact that Phoenix is continuing to get to the top of every chart I look at. Now, another thing that Ken looked at was something called renter by necessity. Yeah, so in other words, people that have to rent. It's not a choice. They just have to rent. And Phoenix topped that list also. Yeah. Now, one of the things that you really want to know something about is job growth. And Ken went out, he did the research for us. So Phoenix comes in right at the top for job growth, literally right at the top. They came in. So what they measured was they measured the 6 months prior to October of 2021. So that was the measurement date. So basically they went and they looked back at, what is that, April? So from like April to October of 2021, they wanted to know how were jobs growing? And Phoenix, well, they're right at the top, 6.5%. Year over year, the growth was 25.3%. Remember when we went through that period of time in the country where we had very high unemployment? Remember that? Well, one of the states that got out of that high unemployment first was Arizona, and was Phoenix that was leading the way. All these great reasons to invest in Phoenix. Here's another thing. This is what I want you to understand. I don't want you just to willy-nilly decide, okay, we got to invest in Phoenix because Al did a show based on Ken's data and Al likes Ken's data, so therefore this must be a great place to invest. And I will tell you, yes, it is a great place to invest, but I want you to be cautious. I want you to understand what you're investing in. I want you to understand what the asset is in its current state. And I want you to understand where that asset will get to based on the plan that the person you're investing with puts together. And maybe the person you're investing with is yourself. Make sure you've got a good plan. What you want to make sure of is that asset, when you put the money to work, that money is going to work the way it intended to work. And it gets you the returns that you're looking for. Let's talk a little bit about how maybe Phoenix compares. Here, let's go to some of the Texas cities. Houston and Dallas. Both of them are doing really well when it comes to multifamily investments. But notice when I talked earlier in the show, I did not mention Houston or Dallas because they didn't make the top 5 for the information that Ken was exploring. However, what I want you to understand is how these assets have been positioning themselves during the pandemic. And here's what we found. If you just look at that rent growth statistic, what you find is that the rent growth in Phoenix has outpaced the rent growth in Houston by a 3 times multiplier. Yeah, you heard me correctly, a 3 times multiplier. It has outpaced Dallas by a 2 times multiplier. So that means Dallas is actually doing better than Houston as far as rent growth. But Phoenix is basically cutting their knees out. It really is. Here's another thing that you need to know about the investing environment in Arizona. One of the challenges that we have with owning assets in Texas has to do with property taxes. Yeah, property taxes tend to be higher across the board in Texas than they are in other states. So that's part of the reason that Texas doesn't have a state income tax. They get their tax money through real property taxes. Having your property taxes as one of your largest expenses can be significant when you're trying to increase the net operating income of your property and therefore increase the value. In Arizona, they have taxes there too, but the rates aren't as high. So you actually don't pay as much in property tax in Arizona as you would for a comparable property, say, in Texas. There's another thing that goes on in Arizona, or I should say doesn't go on in Arizona, that kind of happens in Texas. Texas tends to be the beneficiary of all kinds of weather systems. Yeah, we have hurricanes that impact Houston. We have tornadoes that impact Dallas. We have winds, because we do get winds everywhere else that we don't get hurricanes. And as a result of that, and the fact that we've had so many natural disasters over the last, 5 to 10 years, the insurance rates have gone up kind of significantly in Texas. But in the desert, they don't have hurricanes. They do have some winds, but they usually don't get tornado winds. And as a result, there aren't as many damage claims based on natural occurrences in the desert, and as such, the insurance rates tend to be lower. So if you think about it, if you can control your expenses in the form of property taxes and insurance, and those two things, and I'm just here to tell you, those two things are always your number 1 and number 2 major expense. So you have to control and manage those expenses. And if you put your money in an asset in Arizona, and that asset is moving the NOI needle faster for you, you're going to get to your target price that much faster. Part of the reason I'm investing in Arizona now.
Del Walmsley offers some tips on a better lifestyle.
Even as independent as you are, when you own and work in your own business, if you stop working, you're right back to where you were if your boss cut you off. If you don't get up and go to work, you're not going to earn any money. And so you need to learn how to become interdependent. Now, even after you become interdependent, you're going to start working on something called mastery. Mastery is something that is so different than just doing. When you master something, you are going to be able to anticipate and eliminate all of the problems that would normally occur to the guy just trying to work his way through something. You're in front of the problems, not behind the problems. You've got the thing figured out so well that when you start a new business, it's nothing.
If you'd like to find out how we do this, go to lifestylesunlimitedworkshops.com. Get signed up, and let's get you going.
The Lifestyles Unlimited Real Estate Investor Radio Show is for entertainment purposes only. Please consult a professional regarding your personal investment needs. Nothing presented on the Lifestyles Unlimited Real Estate Investor Radio Show constitutes an endorsement, recommendation, offer, or solicitation to buy or sell any product or security.